One of the challenges many traders face regularly is identifying the break of support and resistance areas. The price crosses these areas in many cases but resumes its previous movement. If traders can distinguish a valid breakout from a false breakout, they may close their correct trade with a loss and open a new trade in the opposite direction. But shortly after, the second trade also faces a loss when the market returns to its previous movement, resulting in a double loss. To correctly identify a valid breakout, you should know that it has two key elements, the warning and the confirmation. The breakout warning can be associated with the appearance of one or more of the following situations: price gaps, tail closes, and extreme price ranges. Price gaps are among the most common occurrences in the area of support or resistance. This happens when the price opens higher or lower than the previous close price, providing an area where no trade has been made. The formation of a price gap is much more important than other warning signs, and its appearance in support and resistance areas shows that these regions are no longer valid. Therefore, it is unlikely for the price to reverse from that area. One of the most impressive features of price gaps is their magnetic effect. As you can see in these examples, in many cases after the breakout, the price returns to the gap, and after a retest, it continues on its path, which can provide traders with exceptional trading opportunities with excellent reward to risk ratios. But sometimes the price moves so quickly that it doesn't return to the gap after the breakout, and continues to move with high momentum, even though in many cases it fills the gap after the trend is over. Tail closes is the name given to the candles in which the close price is at or near the high or low of that candle, so we don't see a shadow in that area. You may know them by names such as the closing Marubozu or any other phrase. The naming doesn't really matter. If you notice such candles when the price hits the support or resistance area, you should be extremely cautious because they are regarded as one of the first signs of a breakout. The simultaneous appearance of 2 or 3 warning signs on the chart can multiply their power and performance. As you can see here, the combination of a price gap and a closing Marubozu has caused the price to surge with intense buying pressure. Extreme price ranges is a term that refers to candles with long bodies and ideally small shadows. These candles somehow reflect the current trend's strength. But how do we identify these ranges? One of the ways to identify these extreme ranges is to compare them with the average ranges in the market. As a general rule, when ranges are larger than twice the length of the average market range, they are considered extreme price ranges. Of course, measuring them independently is unnecessary, enough to detect their unusual size with your own eyes. The extreme price ranges can be seen in different forms, such as trust breakout, breakaway lap, and breakaway gap. In trust breakout, the low of the breakout candle is above the low of the previous candle, but still below the close of that candle. In breakaway lap, the low of the breakout candle is above the close of the previous candle, but still below the high of that candle. And finally, in breakaway gap, the low of the breakout candle is above the high of the previous candle. The opposite is true for a bearish scenario. Remember, when analyzing these 3 patterns, their strength increases from left to right. Also keep in mind that the volume of the breakout candle should be greater than the volume of the previous candle. In other words, we should notice a spike in volume. Although warning signs may imply that support or resistance may not be valid anymore, the market has often bounced back despite the formation of such signals. Therefore, it is essential to evaluate the next price movement. A true breakout occurs when the price confirms it after the appearance of warning signs. This happens when the market forms a bearish or bullish candle outside the support or resistance area. Also, the aforementioned candle shouldn't be a doji or any candle with a small body. In this example, you can see that the price first broke through the resistance by forming a long candle, but the next candle that appeared above the resistance was a doji. After that, the price returned below the resistance by forming a powerful bearish candle. Therefore, the break of the resistance has not been confirmed, so going long is entirely off the table. I hope you liked this video. If you found the information in this video valuable, please share it with your friends and help us with YouTube's algorithm. Thanks for watching.